Devon Energy had earnings last week and the results were less than stellar. The stock tanked and dropped 19% in just 1 week. In this video, we will discuss why Devon missed earnings. What is the outlook for Devon Energy moving forward? Why now is the right time to sell a put vertical in Devon Energy? And we will show you exactly how to place that put vertical option trade and capitalize on the opportunity with Devon Energy.
Hey guys, Darren here. Thanks for joining. We talk about action steps you can take today to increase profits and reduce risk in your options trading portfolio. Please check out and download the free options workshop in the link below.
It talks about the two main reasons why options can be less risky and more profitable than just buying stocks alone. It also details how to profit in both directions and pick your win percentage, which you can't do just buying stocks alone. Also, please hit the like and subscribe button below. I appreciate it and it helps get the video out to more people. Disclaimer, I'm not a financial planner and I'm not recommending trades. Please do your own research, and if you're new or learning options, I recommend you start small. Devon Energy reported fourth quarter earnings of $1.66 per share on revenue of $4.3 billion. The consensus earnings estimate was $1.75 per share on revenue of $4.6 billion. What was the reason Devon missed earnings and the stock tanked? Well, there's a few reasons. Devon lowered its dividend payout. For the second quarter in a row, the oil producer's total dividend outlay was lower than the prior payment. While Devon's cash flow was higher year over year, it declined compared to the last 2 quarters. Devon's dividend payout is directly correlated to its cash flow. Devon pays a fixed base dividend that it can sustain at lower oil prices. In addition, it pays a variable dividend up to 50% of the quarterly free cash flow. With free cash flow falling because of lower realized prices, Devon's variable dividend fell. That policy gives investors a firm income floor from the base dividend, with the potential for a high ceiling because of the variable component. This is actually a good thing. Devon has been steadily raising that floor as it grows production and reduces costs. However, the variable payout will continue to rise and fall with its cash flow. Devon Energy's variable dividend policy allows investors to capitalize on higher oil prices. However, that upside also has its drawbacks, since the payout will fall alongside if oil prices fall as well. Supply and demand and inventory levels also affect Devon. It's one of the energy companies that's very sensitive to oil supply and demand. Oil investors recently got inventory estimates that came in higher than expected. Higher than expected inventories could lead to weaker demand than expected. Therefore, the price of oil fell on the news. Oil prices didn't get any help when the PPI, the Producer Price Index, came in much higher than expected. That report, combined with the higher than expected CPI, which is the Consumer Price Index, data, renewed fears that the Federal Reserve would likely hike interest rates higher for a longer period of time. Higher interest rates tend to raise the value of the dollar versus other currencies, and because oil is priced in dollars, higher rates tend to depress oil prices. In addition, hotter inflation might be fueling fears of a harder landing or recession down the line, which has the potential to lower demand. The recent dip in oil does not help Devon Energy. However, do you really think that the move to cleaner energy is here and oil prices will continue to decline? Check out the video we did last week on crude oil, with prices going forward until at least the next election. I'll put a link down below. It covers why oil prices will likely remain high, and the world's need for oil and gas is here to stay for quite a while, and it's not going away anytime soon. What is the outlook for Devon Energy moving forward? Although Devon missed on the expected top and bottom line numbers, overall, the company posted solid results. Oil output hit a record high while operating cash flow was up 18% year over year. Many people, including myself, now believe Devon is undervalued at a 5.85 price to earnings ratio for a stock that has such solid fundamentals. It would be difficult for it to drop much further at this point after just having a 19% price drop. Devon is going to continue to do well in the current environment going forward. So let's look at getting long Devon Energy using stock options. Let's go to the Tastyworks trade platform. It's the best platform for trading options. I'll put a link down below. We punch in DVN in the upper left and make sure to hit the trade tab in order to see the option chains. We want to pick the expiration date in the option chain that is closest to 45 days to expiration. We are right in the middle, so in this case, we're going to pick the April chain to give us a little more time to be right and collect more premium up front as well. We look to sell the nearest out of the money put option and buy the next further out of the money put option. However, in this case, Devon, with the recent huge drop, we are going to go slightly in the money. So we click the bid price at $4.50 to sell the 55 strike option and ask price at 91 cents to sell the 45 strike. Overall, we are collecting $370 up front by selling this put vertical in Devon. Let's switch to the curve mode by hitting curve in the trade tab since it's a little more visual and you can see the profit zone in green. Again, we see the amount we collect in the credit for this trade is $370 since there are 100 shares. So this amount is placed in our account the minute we hit review and send and place the trade. From here we hit review and send and place the vertical spread. Now let's take a closer look at some of the parameters and exactly what we're doing. As far as the setup, we are selling the out of the money put closer to at the money, and we're buying the out of the money put further away from at the money. The directional assumption is bullish. We sell a put vertical spread when we are bullish and believe the stock price will increase. The ideal implied volatility environment is high. We like to sell verticals when IV is high in order to collect more premium. The max profit is the credit received when we open the trade. So in this case, it's $370. The buying power effect is the max loss. It's the amount of capital that's required to place the trade. In other words, it's how much capital the trade is utilizing. This is also the maximum amount that we can lose since it is a defined risk trade. The buying power effect equals the width of the spread minus the premium collected. In this case, it's $10 minus the $3.70 we collected, or $6.30. In other words, with 100 shares, it's $630. The vertical spread is a cost-efficient way of investing. In this trade, we're using $630 and collecting $370. That's a 41% return on capital in 61 days if the option remains out of the money and worthless at expiration, or a 284% annualized rate of return. So as long as the stock stays above the 55 short put strike price, we keep that max profit. The break even is the 55 short strike minus the net debit received. So it's 55 minus $3.70 or $51.30. We don't start losing money until the stock moves down to this point. So if it stays where it's at or even moves down some, we still profit. The put vertical option trade is a cost-efficient way of investing. We're able to collect a good premium on the upside while limiting our downside risk. Now is a great time to consider selling a put vertical in Devon Energy.
All right, guys, I put a link down below for the free options workshop. Be sure and grab that. Also, let me know what you thought of this trade and what you're trading in your options trading account. Thanks for watching and see you in the next one.